Three mistakes which have costed me a lot of money in the stock market. I think this is an amazing video to do on Thanksgiving, as I'm very thankful for all your support and everything you have given me throughout the years. And I believe this video is going to be very helpful to a lot of newer investors, so you don't commit the same mistakes that I made and you don't lose your money learning things the hard way. I lost my money the hard way, learning a lot of those lessons and making a lot of those mistakes. So if I can help you maybe avoid one of them, and if I could help you learn something through this video, I'll be very, very happy. And I hope you enjoy it as always. Now, one of the biggest mistakes I made over the last 4 years, and this is by far my biggest loss so far, is a stock was called Warner Brothers Discovery, ticker symbol WBD, which I shared on YouTube channel. Now, WBD, I started buying it in 2022, in late 2022. The reason why I was so interested in WBD is because it was merging with Discovery. So back then, it was only Discovery stock, and then it was merging with Warner Brothers from AT&T. Warner Brothers wasn't public, so you do have some financials, but you don't have the full picture. So whenever they announced the merger, they announced something called a pro forma number. Pro forma number is the estimate of the potential, let's say, revenues, that whenever those companies become one, this is the kind of revenues they're going to put up. This is the kind of free cash flow estimates they're going to put up. So I looked at the pro forma number, and the stock was trading at like 5 or 6 times free cash flow on a pro forma basis. So I'm like, this stock is dirt cheap. There's just no way. And Discovery is an amazing brand, and Warner Brothers is going to add a lot of value. So I bought the stock. And then once the merger has occurred and they became WBD, they became one company, the CFO looked at all those pro forma numbers, and he said that the Warner Brothers financials were a little bit worse than expected, so they had to lower the outlook. And every quarter they had to lower the outlook because the outlook from Warner Brothers that made those pro forma numbers were just too inflated. And then I kind of learned the lessons that I really caught in a trap when a lot of those pro forma numbers are inflated in a way to cause a lot of the analysts upgrades on the stock, and the analysts were upgrading the stock like crazy, so the insiders can sell at a very high price, and then you end up holding the bag on something called a pro forma number, which it's not even real. You're not even sure if this is going to be the right number. And that was a mistake I made, and I ended up taking a 27% loss on WBD, and I sold it about $21, $22, I believe, in early 2023. Now, yes, if I DCA'd, maybe I'd be back to break even by now. But if you look at the opportunity cost over the last 3 years, the S&P is up a lot, and many stocks are up hundreds of percent. So I don't really regret selling WBD. But now I don't really mess with mergers, especially if the other company is private. You don't know the actual pro forma numbers. So I don't really mess with mergers anymore. And it's best to wait for the merger to be completed, look at the actual number, and then make the decision, not try to FOMO and front run it and invest in a pre-merger setup on some kind of imaginary pro forma numbers. And that was my biggest loss so far. The second mistake I made is selling stocks too early. And the reason why I did that is because I believe the stock was overvalued, or I believe the stock has just gone up too quickly. And I'm sure it has happened to you guys at least once or twice, where you buy the stock goes up 20, 30, 40% within a few months. You're like, this is too much. The stock just can't keep on going forever. Maybe it looks a little bit overvalued. So I'm going to sell the stock, and then maybe I'm going to buy back in whenever we have a crash. The crash never happens. The stock takes off. Palantir goes to, I don't know, $200 or whatever it's trading at right now, or $130, $140. And it never goes back to $20 or $22 or $25. And this is a mistake I made with Apple. I bought Apple in 2018 in November, around 14 PE. The stock went to 12 PE back then, and Warren Buffett was buying it. So you had the backing of one of the best investors of all time. But then the stock has gone up too quickly. It went up like 50% to late 2019. So I made like 50% in like 10 or 11 months, and it was trading at 18 or 19 times earnings. And I'm like, I bought it at 13 times. Now trading at 18 times, it's overvalued. So I'm just going to sell the stock. Now, the truth is, if I took a 5-year outlook on the stock and I tried to value their services revenues, which were growing rapidly back then, and I put up my valuation model, I would not have sold Apple after it went up 49 or 50%. And I should not have looked at the stock price to influence my decision. I should have looked at the improvement in fundamentals. So sometimes the stock goes up 100%, but if earnings per share is up 100% as well, then the stock hasn't really moved on a fundamental basis. It's just as cheap as it is before it doubled. If earnings per share has also doubled and you believe it could continue to grow over the long term. So this is a lesson that I learned the hard way, but I still have something related to valuations where I don't like to overpay for something. And if I own a stock and I believe it's getting overvalued, I don't sell the whole position. I kind of trim it a little bit like I trimmed with SoFi. So if it keeps on going up and it's not too overvalued, I'm like, okay, I just let it run. But now I have no regrets and I took some profits because I know the stock is kind of overvalued, but it's not overvalued to the extreme. And I think this is something that most retail investors struggle with, mainly because we've been having a FOMO market for so long where stocks just keep on going higher and higher and higher. But if you study history, a stock like Microsoft, which was the leader back in the dot-com bubble, it took 16 years to get back to break even. 16 years, guys. And many stocks like Cisco took like 20 or 21 years to get back to break even. So the truth is sometimes the market gives you selling opportunities. It gives you 5 or 10 years worth of gains today. And you have to take advantage of Mr. Market and sell the stock, just like you would take advantage of him and buying stocks whenever they're crashing and they're going down. People love doing that, but they can't sell a stock because they get emotionally attached to it. But for me personally, I think I made a mistake with Apple because it was not too overvalued. If I really checked out the numbers, it was not too overvalued at all. So now I only sell a stock if I believe it's just like bubble territory, extremely overvalued. If I believe it's overvalued, I trim a little bit and then I add back a little bit later. So I don't have any regrets on not trimming, and I'm saying it's overvalued, but I don't just sell the whole position just because a stock has gone up or just because it's slightly overvalued. And I think this is very, very important. Now, the last mistake that I made and I should have done earlier is mainly not buying the growth stocks. A growth stock to me is mainly a company that is in its early stage of the business cycle. So all companies pretty much start as stage one, which is the startup, pre-revenues and not doing too much, you're raising capital. Then it enters a hyper growth phase. Maybe this is, where maybe not the valuation, but maybe this is where ChatGPT is at right now, where it's just rapidly growing. And this is where a lot of companies at, where they're just early in their hyper growth phase and they're growing like crazy and they're doing really well. Maybe they're unprofitable, they're not too profitable. Then in stage 3, they start funding themselves and they start turning profitable. Stage 4, they get operating leverage. This is where you start seeing the moat. You're not going to see the moat in stage 1 or stage 2. So a lot of people, they skip the growth stocks because they believe it has no moat. But it's still in its early stage of the cycle, and you're not going to be able to see the moat before like stage 4, stage 5. Stage 5 is whenever the company gets mature and they can't really find anywhere to reinvest the capital. Growth is peaking, there's a lot of competition, so they start paying dividends and doing buybacks and doing all these things. And there was an old saying in investing is whenever a company starts paying dividends, this is a good time to sell. Now, this is no longer true, but whenever a company starts paying a dividend, it normally means that it has reached the maturity stage and it just cannot find any better place to invest the money. So it's just returning it to shareholders, which is always like the lowest kind of return way to invest capital is to pay a dividend. That's like the worst one, which is why Buffett has never paid a dividend. And then stage 6 is in decline, where all companies eventually reach the maturity, peak growth, a lot of competitions. They get disrupted by the stage 1, which is the startups and the growth stocks. They disrupt the companies in stage 6. Now, I did not understand all those things. And if I did understand them, I would have bought Tesla at $20. I remember seeing Tesla at $20, and I remember looking at it, and it was not making too much money, but I saw the future in terms of electric vehicles. I saw a massive TAM. I saw a price to sales ratio that was not too expensive, and I saw, a lot of smart people bullish on Tesla. But I couldn't buy it because I just felt it was like bubble. It was just too hyped up, and I was a deep value investor and buying stocks below liquidation value. So I just could not buy Tesla stock, and that would have been a life-changing kind of stock for me. But I took this lesson And I invested in many stocks, growth stocks throughout the years. And now one of my biggest gainers are the growth stocks. And all of those stocks were purchased from 2023 to 2025. The biggest one is Mama, which I shared with you guys. It's a food company. This stock is up 555% in 2 years. I don't know many quality stocks that are up 555%. Visa is not going to give you a 500% return. Hims, which I bought, it was unprofitable. It's up 327%. Robinhood, I bought it in April, just a few months ago. It's up 297%, 95% in like 7 or 8 months. This is absolutely crazy. Now, the truth is those stocks are much riskier because sometimes they're unprofitable, they don't have a competitive advantage, they don't have a wide moat, and it's just a riskier proposition in general, which is why a lot of people tend to skip them. But for me personally, the way I manage risk with them is I implement the right position sizing. So I realize that those stocks don't have a wide moat. And the stocks that have a wide moat, let's say something like Microsoft or Amazon or Meta, I make them a larger percentage of the portfolio because they're not going anywhere and they're stable companies. But those risky stocks that have a lot of potential, let's say explosive upside, 10, 20, 30, even 100x, but they have a lot of risk, I make them a smaller percentage. This way, if I'm right on the stock and I put in 1 or 2% of my portfolio, I make a lot of money. If the stock goes up 20, 30, or 40 times, I don't need to risk more of my own hard work or my own capital. The market's going to give me the appreciation. I don't even need to risk more than 1 or 2%. But if I'm wrong and the stock goes down 50% and never recover, then I lose like 0.5% of my portfolio or 1% of my portfolio. So that's really a good risk to reward setup. And if I was focused on that, if I just put in a little bit in Tesla, I'm like, okay, the upside is huge, but if I'm wrong, I don't lose too much. It's just some kind of a gamble that is with a good risk to reward setup. And now I do a lot more of those things, but I don't do it blindly. I don't just buy any growth stock that just looks like a good opportunity and it's just too hyped up and it has a huge TAM. There's a framework that I use, and I shared an article for free on my Patreon, which you can join for free, and you can check it out and read my checklist on what I look for. But this is what I look for with the growth stock. I look for 3 to 5 times sales. This is like the sweet spot, but 10 times sales is the ceiling. Now, the reason why we use sales is because some of them are unprofitable or some of them are in their early stages of the business cycle. So they're not showing profitability yet. They're being unprofitable by choice because they're reinvesting in marketing and reinvesting in themselves. This is what Amazon did for many years, by the way, and people skipped it because it was not too profitable, but they were doing it by choice. So this is why we use a sales multiple. We want a minimum of 20% revenue growth, at least 20%, preferably 25%, 30%. We want a clean balance sheet, so no debt, hopefully a decent cash position. We want high gross margins, because if it's a low gross margin business, that means there's a lot of competition and it's just not a good business in general. Because we cannot see the moat early on, we want to see if they have some kind of an edge, some kind of a tiny competitive advantage, a tiny moat, you could say. And if it has high gross margins, then you could say it has some kind of pricing power, something different from other competitors. So if they have 70, 80% gross margins, this is always a good sign. And this is something that I look for. And I also look for stocks within 1 year of profitability. I don't want to bet on 2030, 2035 profitability and buy pie in the sky, like, I don't know, SPSE or whatever, Virgin Galactic or whatever those kind of hyped up stocks are that want to go to the moon or whatever. I don't do that. I want profitability within 1 year, maybe maximum 2 years. And I want improvement quarter on quarter in terms of losses. If I'm not seeing that, then I'm not going to touch the stock, no matter how amazing the fundamentals are and no matter how good the story is. I'm not Cass Hood. I don't invest in stories. I want to see the numbers. And if the numbers are improving, then I buy the stock. And that was my video for today. If you want to join me in my group on stocks that I buy and other growth stocks that I discover early on, and I have a good history of having a good track record of buying those stocks and discovering them early on, especially during sell-offs. So if you want to join me and learn a little bit more about my strategy and growth investing and things that I do, you could check out the link here if you're interested. But thank you again for watching. Hope you enjoyed it. It was not financial advice. Happy Thanksgiving, and I'll talk to you in another update.